Hey guys, welcome back to another video. It's Will here again, and in today's video we're going to be going over an advanced options strategy that I use in trending markets, and more specifically it's going to be about pulling premium forward using written put options. So if you guys don't know already, one of my main strategies that I use for my portfolio here in the trading account is the put wheel strategy, whereby you write weekly puts, and then if you get assigned the position, you will write covered calls on the position. If you don't get assigned the position, obviously you just get to pocket the premium. This is otherwise known as a positive EV strategy, meaning positive expected value, because you are assuming the premium risk. You are an insurance provider, and it is otherwise known as taking the other side of long options here. You are selling options, selling premium, and collecting weekly realized income. But in today's video here, guys, if you haven't seen my video breaking down the basic put wheel strategy, I will link it above in the video right now. So make sure you take a look at that to understand the basic strategy. This second video is going to be a more advanced strategy here that I use in terms of pulling premium forward. So we are going to, instead of write weekly puts, we are going to go a bit further out on the options chain here, usually from a 3 to 5 week period. And this strategy usually works in very bullish markets here, in trending markets to the upside. It's worked excessively well here, guys, for a number of years. It's a very well-known strategy here by people who write options. So I figured that I should bring it to you because there's not a lot of people who actually make videos on this concept of pulling premium forward. So let's go over the details of the strategy, shall we? Now, this is what I call the breakout retest strategy. So I will only use this when we are in a breakout and then retest environment, meaning that we're breaking out of an area which is previous resistance, like you see right here on the SPX, breaking out of this area and then potentially retesting the area before a future leg up. So it requires, number one, that the index is in a long-term uptrend. You can see here, guys, that we've now established a beautiful longer-term uptrend from pretty much 2023 rolling into 2024, and I largely believe that 2024 and 2025 will be the start of the new bull market. This strategy worked excessively well for me all the way back here 2020 through 2021, pretty much all the way here. Essentially any situation, guys, where you don't have a large market calamity, right? Obviously, when things really hit the fan, this is not going to work too well. So you want to have a general trending market here, right, to be playing this strategy out of. You can see, guys, that usually when the market is trending healthily, you can get several years out of this strategy here, guys, being able to pretty much play it on your weekly breakout, retest. So whenever you have a larger form weekly pullback, this is when I will be using this strategy. You can see it worked very well here, 2016 all the way through 2018 as well. And over here, you also had a beautiful year period here, 2012 all the way over to 2015. So when the market is trending correctly, and we don't have potential catalysts of major recessions or major inflation crises like we went through, or potentially a pandemic, and the market is just normal, although you will have your occasional events here on a monthly and bi-monthly basis in terms of headlines that may shake the market up. Those are going to be your weekly pullback, aka the breakout retest zones, right? So we're going to make the play here on the breakout retest. So that's point number one. The index needs to be in a long-term uptrend, which I do believe it is a perfect opportunity right now to be playing this strategy. Number two, you want to be doing this on a solid company. This is my number one rule for writing put options as a whole, whether you're doing it on the weekly or 3, 4, 5 weeks out, like I'm about to show you here, guys. You need to want to own the company at the strike you write. If not, please do not be seduced by the premiums on some contracts, on some growth stocks that could leave you potentially trapped. So it needs to be a solid company, solid fundamentals, expanding EPS, and expanding revenue. Number three, we want to see the company in a weekly and monthly uptrend. This is very important as well. Needs to also be following the pattern of the index's weekly and monthly uptrend. This is where it works best when your higher time frame bulls are in control and we're breaking out and retesting a previous area that was resistance, which will now be support. So this is very important that we do this here on a company specific basis. Now, point number four, you need to also try and couple it with 4-hour or daily oversold RSI. All the examples that I'll be bringing you here, guys, you're going to see it's a very, very simple strategy. I'll give you guys about 4, 5, 6 examples on stocks that are currently doing this. You want to try and couple it with 4-hour and daily oversold RSI levels. So RSI is an indicator that most of you traders are going to be using. So we'll want to target those oversold conditions for the bounce. The entire gist of the strategy, guys, is we are playing the bounce. We are writing premium at a specific level. And then when the bounce occurs, it doesn't necessarily mean to say that we're waiting for something to all the way come back to its previous highs. We just are looking to play a little bit of a bounce. And with the little bit of a bounce here, guys, so much premium is going to come out of the contract because point number 5, we are playing them 3 to 5 weeks out. Why 3 to 5 weeks out? Well, this is just basically the nature of options, guys. When we're looking to play a bounce, you want to play the options here that are decaying the quickest. So here I brought a nice little chart here. This is your days till expiration and the time decay in the premium in the option price. So as you guys can see, in the last 30 days, this right here under my big head is 0. You can't see it. But if you can see right here, the fastest decay of this curve usually starts occurring between about 40 and 30 days before you really get your exponential decay to the downside, which means that if we're writing options in this sweet spot right here and we get a little bit of a bounce here, the premium will come out of the contract very, very quickly. We do not need to wait. Let's say we're writing 3 to 5 weeks out on these puts. We're not trying to wait for the entire 3 to 5 week period. You guys will see that usually if you do get a bounce, you'll be able to pocket a large percentage of this entire 3 to 5 week premium on the contract in only potentially 1.5 weeks. So our time of the trade is not the entire 3 to 5 weeks. It'll only be a portion of the number of weeks here that we're going to go for. And I'll explain when we go over the examples in the stocks. But for now, just write down these bullet points. These are the main bullet points of the strategy. And point number 6 here, it is going to be targeting between 0.5 to 1% per week, which is the exact same percentages that I will be looking for my weekly put options. We will be replicating this as well with this strategy here on the longer term basis. So without further ado, let's get into some numerical examples so all of this makes a bit more sense. Now, starting off, let's start with the stock here. I really like this one a lot. Let's start off with, let's say, QCOM. So here's the strategy, right? You will see that in terms of the breakout retest, monthly consolidation, now we are setting the monthly uptrend in motion, breaking out of our previous area of resistance, and now looking to retest this zone as support. You see this best on the weekly chart. Nice weekly uptrend started. Now we're just looking to retest this previous resistance level as now support. So QCOM is going to be on my watch list for this strategy, potentially down into the 130 all the way down to mid $120 range is what we're going to be looking for here. So let's pull QCOM up here and let's go shopping for some premium now. All right, so if we're looking for the $130 mark, let's say QCOM isn't necessarily quite at my sweet spot yet, but let's say we get a little bit more red here. I'll show you everything in the strategy is going to be respected. So key bullet points here, just remember, solid company. I like QCOM. Index is in a long-term uptrend. Company, weekly, monthly uptrend. We've confirmed that. 4-hour daily oversold RSI. So let's take a look at QCOM. QCOM has just come off here. 4-hour oversold RSI, very, very, very clear. And you can see the MACD is even curling up for a little bit of a bounce now after some healthy daily consolidation. The daily is not oversold, but we still can potentially play this 4-hour oversold. If we do, for some reason, pull into the 130s for a second daily leg down, that would probably get us into daily oversold conditions as well. And that's what I'm looking for on this stock. But let's just do this example for now, okay? So let's say we're targeting the higher end of previous resistance. Let's call it the 133 level right now. Well, we're going to go shopping here, guys, right? So let's take a look. We're going out 4 weeks here. So 3 to 5 weeks, 4 weeks. And we're going to be looking here at the $133 strike, which is your previous resistance here, the previous zone here that we're kind of breaking out of and now retesting. I would prefer it down to the 130s, but it's not close enough yet. So let's, just for the purpose of example, guys, I'm just going to show you how we go shopping for these options premiums, right? And then you can do the math on all the companies that you like, and you'll be able to do this fairly quickly as well. So let's say we take the 133 strike for 4 weeks out. The strategy is as follows, okay? Let's do a bit of math to see if it follows our premium requirements now. So let's take the premium, the average between the two, let's call it about $3.35 if we can get put right on this option here for February the 2nd. So 335 divided by our strike here is going to be 2.5% for 4 weeks. All we got to do is divide that by 4, and you will see that we are between our 0.5% to 1% rule. This is 0.6% per week. So it does follow our rule. So the name of the game here, guys, is to be playing this. We are going to write this option right here for $3.35. And then if we get a little bit of a relief bounce here, the premium, the money on the contract will come out of this contract fairly quickly. If QCOM bounces from here over the next week, let's say it bounces all the way up to 139, 140, you will see the premium in this contract will evaporate. Usually, guys, you can see these things run about 40 to 50% in 1 week, which means, let's say that QCOM runs to 140, and I'll show you an example of this happening more specifically on AMD that we're going to do next, okay? This is just a theory for now. So let's say the premium evaporates on the contract. Let's say we run on QCOM up to about $140 here. You will see that the premium in this contract, because we're writing very close in terms of time, when we get a bounce, the premium will come out of this contract a lot. So let's say the stock moves to about 140, then the premium on this contract in a theoretical example may only be about $2 remaining. So it'll go from 335 all the way down to $2. Well, what have we effectively done, guys? We have pulled forward premium, okay? So I'll do this in a numerical example. Let's say it goes from 335 down to $2. That means we pocketed 335 minus $2. We pocketed $1.35, right? So $1.35 in terms of our strike price that we wrote would be 135 divided by 133. That would be over 1%. So if QCOM only has 2 days of rally, and a contract goes down to about $2, we will be making 1%. Now, the name of the game was to be making 0.5% to 1% a week. If you guys can make 0.5% to 1% in only a few days, guys, there's no need to hold this contract to expiration. And it gets even better if it has a few more days of recovery. Let's say it rallies for 3-4 days in a row in terms of a daily bounce underway here. Well, the premium out of the contract will be even better here, guys, right? So you may be even able to get down all the way to about $1.50 or whatnot, which means that you would pocket. Let's say it goes down to about $1.70, right? We wrote it at 335. Let's say it goes down to about $1.70, okay? So that means that in a week, let's say if the contract goes down to $1.70, we'll have pocketed $1.65 in premium, AKA that is half the whole premium that we wrote on the entire contract. Now, let me ask you a question here, guys. Let's say after 1 week, you've already pocketed half of the entire contract. Does it make sense to hold the contract for 3 more weeks when you still only have about 50% left to get? Let me say that again, right? If you make 50% of the contract value in 1 week, why would you hold it for 3 more weeks for the additional 50%? It doesn't make sense, does it? You'd rather close the trade and go shopping for another one of these where you can pull premium forward in the way that we're doing. So essentially what we're doing here, guys, is we're basically using premium and time decay here to our advantage and wanting to play this bounce to pull when the premium gets pulled out of the contract, we can pull forward our gains. So rather than waiting the full 4 weeks for this, you will close the contract at 40, 50% profit after 1 week and not have to wait 3 extra weeks for that remaining 50%. So I hope that makes sense, guys. There's a bunch of different examples like this. I'll show you one that's coming to mind right now in the name of AMD. So AMD, classic case of breakout weekly uptrend here, breakout of your previous 52-week high zone, right? We're breaking out. Now we're retesting this zone as support. And there was a beautiful opportunity over the course of the week. AMD, not daily oversold, but was 4-hour oversold. So we saw oversold conditions. It was next to our sweet spot. So the sweet spot here was about the 132s, 131s. And now what happened on Friday, we had a little bit of a bounce all the way up to 138. So let me show you what this looks like in real time, okay? In terms of pulling the premium forward. So let's just say you go on AMD here. and you were shopping for options for February the 2nd over the course of last week during this dip, you were looking at this on Wednesday, let's say, it was down to about $135, and you were looking for, let's say, the $132 strike, which is the top of this retest zone right here, right? So here's what would have happened. Okay, you can see now that the price on the contract is about $370, $385. But what was it on Wednesday? Let's go have a look, right? You can always pull these up on the options chart here. So let's take a look at what exactly the premium was on this past Wednesday here. Give me a second here, guys. Let's pull it up. So you can see that on Wednesday was exactly the 3rd of January here. We'll put it up in the quote details here. You'll see that on the 3rd of January, the premium was anywhere between, let's call it $5.50, $5.60 this entire day. That's this range right here. 3rd of January, you can see it right below there on the chart, the calendar right there. So the premium for the 132s would have been $5.62. Well, now you guys can see that that contract is trading at the Friday close here, roughly about $4.80, but it got a little bit higher. Even AMD traded all the way up to about $140, right? So this was a heck of a bounce. So let's say you would have written that option here at about $5.60, right? $5.60 here on Wednesday morning. This contract on the next day pretty much went all the way down to about 430. So 560 down to about 430. So let's do a little bit of math, right? So if you would have waited for $5.60 here for 4 weeks, let's say, and you would have gotten a strike price here of $132, well, that would have been 4%. 4% divided by 4 weeks. That's just over 1% per week here. Now, you could have taken this trade on the Wednesday, right? So take it on the Wednesday right here, and then Thursday or Friday basically closed it for a lot less. So we see right here now, this contract last traded price here was $3.80 here, right? So you could have closed this on Thursday for $4.80, or even better, you could have closed this on Friday here for the current contract price, which is about $3.70. So from $5.60, let's just say you held it till Friday, from $5.60, right, down to the current contract price, let's call it $3.80, you would have pocketed $1.80 in 2 days. $1.80 divided by your strike price, that is 1.4% almost here, guys. So in 2 days, you would have made what you were expecting to make here in a week in only 2 single trading days. So that's what I mean by pulling premium forward. And if AMD continues a little bit of a rally here into the next week, let's say you get 1-2 more days of potential upside here, the premium will come out of this contract like it is water here, guys. So you may even be able to get $3 for this. And the more premium that you can pocket quicker, you don't need to hold it for the extra 3 weeks. The entire strategy here, guys, is writing more premium up front. And then when you get the bounce, you want to just close the trade. We're not waiting for the trade here to last for 3-4 weeks, depending on the timeline you choose. You're just looking to pull the premium forward with the bounce. So otherwise, instead of writing the weekly here, that's why we're writing 3-4 weeks out, so we can write juicy premium here and then pocket the premium as the stock has its bounce. So I hope that really makes sense here, guys. Would have been a beautiful trade here, right? And you know, if you would have held this the whole way through, you would probably be making, right, as we saw, you'd be making about, let's say, 4.2% for about 4 weeks, which is really not bad. It respects our 1% trade here, but if you divide that by 4, that's about 1.06%. But if you were to take if you were to take the trade that we just saw, right, the 560 minus the $3.80, the $1.8, right, divided by your strike, that's 1.4%. So it's even better. And you didn't even have to wait an entire week, guys. You would have literally only waited 2 days and you would have gotten over what you would have expected in waiting in the contract for a week. And as time moves on, this just gets better. If AMD just rises a little bit, stay flat, you will see the premiums do come out of these contracts very, very aggressively. Now, yes, we can hold them to expiry. Sometimes I'll find myself holding these to 60, 70, 80% profit, but you can close these early if you are respecting your math. If you're closing over 1% in a week here, guys, if you're pulling the premium forward, feel free to close, because the name of the game is making between 0.5 to 1% per week. So just do the math on that, guys. If you're in the contract for 2 weeks, well, you want to have made at least 1 to 2%. That's just 2 times 0.5%, or 2 times 1%, depending on the premium of the contract. So I hope that makes sense. That's how we do the breakout retest trade, guys. And there's a bunch of them available right now, right? Beautiful breakout retest trades, right? Look at ADSK, breakout retest of the zone, monthly, starting your new monthly uptrend right here, breakout of this zone, retesting. You see it best on the weekly. Look at this beautiful accumulation range right here. We're now pulling back into this entire previous resistance, which is now support area. Let's call it the 225 zone. So if you're going shopping for ADSK, let's take a look at ADSK premiums right now. Right? Take a look at ADSK premium. Let's say we're going for that 225 mark, because what we're trying to do is we're playing a bounce play right here. We're trying to go for the breakout, retest, and then run. So you'll see that on the 4-hour time frame, ADSK was a bit oversold, not on the daily because it hasn't come down enough. Still about halfway through the RSI. On the 4-hour is oversold, so you can either try and take a bounce play here, or you can wait for a potential continuation of the daily downtrend here, and then try to pick the lower 220 levels. Any which way, guys, it's a beautiful weekly bull control pattern, and also your monthly bulls are in full control. Just very important that your longer time frame bulls are in control. That's when you don't need to be very, very extremely precise with the short-term timing here, guys. You count on your longer-term bulls. So let's say we take ADSK, for example. We're going to go once again 4 weeks out for this trade. And let's say you take, for example, the $3.90 contract here, right? So let's say, for example, 225, let's say the midpoint price right here between the two is 390 and 430. Let's call it 410 for all intents and purposes, right? So you'll take your $4.10, divide that by your strike price, and you will stand to make between, almost 2%. So 1.8% in 4 weeks divided by 4, that's just under 0.5%. I would still not mind taking this trade right here, even though the premium is tiny little bit lower here, but the name of the game is pulling premium forward. So let's say you write these 410s, and then ADSK has a little bit, it comes down a little bit more, then has a juicy little bounce all the way to 235. Let's say that happens within the course of 1 week here, guys. It comes back all the way up to 235. The premium on this contract at that point, guys, should only be remaining about $2, maybe $2.30, all right? So let's just say, theoretical example, just because I've done so many of these, guys, I know how they usually move, and that's usually just take it for granted that that's usually how the proportions will work. So let's say the premium on the contract remaining is only going to be about, because the moral of the story here, guys, the stock is trading about 228, let's call it 229. The premium on the 220s, which is $9 away, is about 240, 275. Let's call it about 260 here on the midpoint price. So let's say we're taking the 225s and ADSK runs to 235. That would be $10 away from the strike. Pretty much the same difference. $9 is away from the 220s. Well, if we get to 235, that's $10 away from 225, which is why you know that usually, right? So this contract right here, these will just swap places essentially, right? So as we move one strike up, well, the 225s will now be reading this about 250, 260-ish, right? So let's say we write it for 410. That's the gist behind it, right? So let's say 410. You take, for example, $2.60 after you've made that in a week. That's 1.5 divided by your current strike price here. That would be 0.66% in 1 week here, guys. So it's better in terms of a weekly basis, in terms of returns, it's better to pull the premium forward on the longer dated contract here, expecting a bounce, than just waiting for your entire 4 weeks to collect. Let's say we just sit here in the contract, right? 225, 4.1 divided by 225 divided by 4, that will be 0.45%, right? So you saw if we wait and it comes up here a little bit and we pull the premium forward, we're actually getting 0.66%. But if we were just sit in the contract for 4 weeks on a weekly basis of ROI, we'd only be getting about 0.45%. So that's why it's juicier sometimes when you see these breakout retest scenarios to really take the longer dated trade and really wait for the options premium to come out of the contract aggressively on any bounce here, guys. That's why I usually do hold these 40, 50, 60% profit. I will look to pull most of the premium forward in a contract here, guys, rather than wait the entire 4 weeks, right? So the name of the game is we're writing 4 weeks out, but after a week and a half, we want to walk away from that contract with 50, 60% profit and tell ourselves, well, listen, it's not worth, if I get 50% of the contract's value back in my pocket within a week's worth of trading, why would I sit in the contract for the extra 3 weeks? It's just not worth it, right? So that's what we do in terms of pulling premium forward. It can be coupled with the breakout and retest strategy. That's when, in my opinion, it does perform the best here. And there's a lot of good ones here, guys. You know, you have some on big tech as well. If you guys like big tech, right? You have Amazon here pulling a very, very, very beautiful breakout retest zone of this 141. If you guys are seasoned options writers on big tech, you guys know that the premiums on big tech aren't that great. Some of the premiums that I've chosen here, yes, they do fall on an earnings week here, guys. I know they fall on an earnings week. I'm sure somebody's going to point that out in the comments. I know we're just doing these mathematical, theoretical examples here, guys. Obviously, your preference is not to be writing on a earnings week here, but we're just doing a theoretical example so you guys understand the math and understand the concept that we're going for. Let's say you want to do it on Amazon. Right, let's target the 140, 141 strike right here, looking for this breakout, retest of this zone before running. Amazon, beautiful monthly uptrend right here, beautiful weekly uptrend as well. So retest of this zone, Amazon won't be necessarily in daily oversold conditions yet, but it is currently in 4-hour oversold conditions and potentially attempting a bounce here. So let's say we go for the 141s, which are going to be about, 4 weeks out just the same. So you'll see right here, on the contract right here on the side. So it's going to be about $3.50, $3.60, right? So that's pretty much what we're going to be looking for. Let's call it 355. So same principle, 355 here, divided by your strike price, 141. That's a 4-week ROI of 2.5% divided by 4. That's your weekly ROI, which is about 6.62% per week if you were to hold this through to expiry. Now, let's say Amazon gets a nice little bounce up here, goes all the way back up to about 148, 149, which would put you about $7, $8 away from the strike price here. Well, let's see, what is $7, $8 away from the strike price, right? From current strike price, 145. Let's just call it 130. They don't have the 138s, 130. They don't have the 138s, 137s here. So let's just say it's about 250, okay? So let's just say you pull about 250 out of that, right? So let's just say we write it for 355. After this is the first week, you just write the option, and then Amazon rises to about 148, 149 here. Well, what's going to happen is your contract is most likely going to be worth probably about $2.50 after a week here. So minus 250, you'll have pocketed 105, and 105 divided by your 141 strike right here is going to be about 0.7%, which is better than our 0.62%, right? If we were to just hold this on a weekly basis. So that's all we're trying to do, guys. We're trying to juice our weekly ROIs by going further out in the contract here and pulling that premium forward. Obviously, right, the longer you stay in this contract, the more money you'll make here, but it all depends on how aggressive the bounce is. A very quick, aggressive bounce will really pull the premium out of this contract very, very quickly. So that'll be the juicier gains. But if you only get a small little bounce, which is the examples I've just been giving, I'm just forecasting a very small little bounce. 2-3% bounce is pretty much all that we're looking for here, right? That is how you pull a lot of the contract premium forward, and you're able to get a juicier ROI than, let's say, if you were to just write the 141s for this week, let's say, right? If you were to just write the 141s for this coming up Friday, well, you'll see, guys, right? Let's take the midpoint price, 0.47 divided by 141. You're only getting 0.3% here, right? So the premium just isn't there on a weekly basis when we're going a decent amount of strike prices down here, right? So that's the moral of the story. It also provides a lot more insurance. So those are the few benefits of the strategy here, guys. It allows us to boost our weekly ROI by a bit more by pulling the premium forward. And it also gives us a heck of a good break even as well. Look, if we go 4 weeks out, and let's say there's always the opportunity that this play goes against us, right? Well, in this case, we're getting $3.55. 355 from 141, right? 141 minus $3. Oops, 141 minus $3.55. They break even of 137.45 here, guys. 137.45 on Amazon currently is going to be a hefty away amount from the share price, right? So 137.45, let's take it from right here, Friday's close, 137.45-ish. That's about 5.3% off of current strike price. So you do get a fairly decent cushion. And that's what we're looking for here, guys. We're trying to get the breakout retest with a little bit of cushion. So in the event that the play works against you, you still have a lot of premium cushion to be working here for, working with here. And pretty much that's the moral of the story here, guys. Just looking for the oversold conditions. So just keep an eye, guys, on all of your criteria for this strategy. It's a strategy that I've been using for the past couple of years. It usually always works out very well, especially on stocks that I do want to own. And like I said, after about a week, even 2 weeks, guys, I'm closing, after 1 week, it's usually in the 40-50% range on the very good case scenario. You just do it on a weekly basis. Is it worth it for you to stay in the contract? That is the most important question that you always have to be asking yourself. Is it still worth my while and worth the ROI to stay in the contract? If after 1 week, you've made 40% of the contract in 1 week, you're not going to wait 3 extra weeks for the remaining 60%. Just doesn't make mathematical sense. You'd rather pull your money out and reset on another play that has a full 4 weeks of premium in it so that you can do this again and again and again. So that was pretty much the pulling forward of the premium using the breakout retest strategy here on our higher timeframes when the higher timeframe bulls are in control. So I hope you guys appreciated the strategy. Once again, guys, if this was a bit much for you, go back and watch my basic options writing strategy here on a weekly basis for the put wheel. I linked it. I'll link it down below in the video as well. So look at that one first. This is a more advanced option strategy here that works very, very well when you're accustomed to writing put options on stocks that you want in areas that you want as well. And you're just looking to juice the premiums here and have a little bit more cushion to the downside in the event that the market moves against you here and you have to take assignment potentially in those 3-4 weeks. Well, at least you have a much bigger cushion here, all right? So I hope you guys enjoyed this video. Once again, it's Will. If you have any questions whatsoever on the strategy, guys, feel free, leave a comment down below and I'll answer each and every one of you in detail. I absolutely love all your questions, so please don't hesitate if you didn't understand anything or if you want to bring extra points that I potentially didn't cover in the video, definitely let me know. And as always, guys, thank you so much for being part of this channel. You've made my journey excessively good so far. I can't thank all you guys enough. If you could, please like the video here, guys, if you learned something today. And if you're new to the channel, please consider subscribing as well. We'd love to have you here. Just over 600 subscribers now and hope to have many, many more. So take care, guys. I'll see you in the next video here. And as usual, we will always be doing our daily market end of day recaps here, Monday through Friday. So make sure to watch those as well. Take care, happy trading, and peace.